And then we were growing really, really fast. So then we were growing 400% year over year. Our customer just grew too quickly, blew out the top of our projections. There was like so much demand. So
this is from a single customer early on?
Mostly driven from a single customer. I was 28, 29 when I was doing the third one. So I was just like, all in, right? If I miss, then I'll just go work for somebody else and go down a normal path. For me, it's like backbreaking customer demand. Like you have so much demand. The problem for the company is not customers. It's like trying to operate the company so that it doesn't fall apart because there's so much demand for your product.
That's product market fit.
Product market fit.
Product market fit.
I called it the product market fit question.
Product market fit.
Product market fit.
Product market fit. Product market fit.
I mean, the name of the show is Product Market Fit.
So I have really bad news for you. The show actually now costs money. So I'm going to need you to wire $10,000 to my account if you want to keep listening. I'm kidding. I just need a review. Now you thought you had to pay. It doesn't look so bad, right? All you have to do is take your phone out, hit a couple buttons, hit 5 stars, and you're done. Thank you. Jason, welcome to the show, man.
Thanks. Thank you very much for having me. I really enjoy what you have been doing. Some great content you've been putting out for everyone in the ecosystem.
Well, it's great to have you on, man. You've had multiple companies, 4 companies now, 3 in the data center space. One was in AI. And one of them, when it exited in 2019, was the 3rd largest exit in Canada that year. So quite a successful company. And then you turn that into kind of your family office. And so now you're on the investment side, done like 20 plus angel investments. So I think like what we'll do today is definitely let's go through kind of some of those stories. We'll spend obviously most of the time on that really successful one and what you learned there, especially about product market fit, because you had pretty crazy pull in that journey. And then like we'll shift over to the angel side. And I think like as an early stage founder, like getting that perspective from somebody who's been a successful founder and now is on the other side and how they're thinking about investing and some of the things you learn, because honestly, you learn a lot as a founder, but then when you go to the other side, you learn different things and just putting that all together. So let's start there. Maybe like brief intro. We'll go through some of those early companies, how you got into kind of building startups in the first place.
I guess a little bit, background. I'm an engineer. I guess I consider myself to be a technical founder. And I would say since a pretty young age, I kind of had a different view on how things worked. And, the one and only job that I had, I kept telling my company how to do what they were doing, and that didn't really do so well. So I went off and kind of started my own thing out of that, and built 3 companies in the data center space, leveraging my engineering background and kind of taking a different spin on kind of a traditional industry, just to make it a little bit better. Lots like death by 1,000 cuts type thing is just kind of tuning and making everything 1% better, 2% better.
Walk me through that world, like data centers. For me, it's like it's AWS, it's Azure, like it's done. But I do kind of faintly remember early as Jim Track 10 years ago, there were these like small, like remember a company called like Hosted Biz that would do like some data center stuff. So like, what year are you getting into how do you even get into data centers? Like, what year is it, and what's kind of going on like in that space at that time?
I started that way back in 2008, 2009 when I graduated. So back then, like AWS was kind of just getting going. A lot of people were building their own data centers in-house. There's really this like significant capital spend that companies had to outlay, early stage companies, in order to like operate their IT environments. So they buy and own and operate their own servers, which is obviously very different than today. But back then, that's kind of how it was done. And 2008-9 through to the last company, data center, started in 2016, the industry really evolved and moved away from companies buying and owning their own infrastructure to really renting it. And it went from renting kind of data center space and not needing to build the data center component to renting the full system and buying units of compute on an hourly, monthly basis, which is the AWS and, the Googles and Microsofts that we have today. So that was kind of the evolution. And the 3 companies that I built kind of followed that evolution and adapted.
Like, I don't know if there's a simple way to answer this, but like, how do you end up having 3 different data center companies instead of just one that you kind of grow over time?
Yeah. So the first company I built was like an engineering professional services data center company. And I had customers that kept coming to me saying like, hey, can you please justify me building my own data center? And I would run the models and I'd look at them and I'd be like, I can make assumptions that make this work, but really this doesn't work for you as like an IT company. You don't know if you're going to be around for 20 years and you're making a 20-year investment in a data center to justify its payback. So I kind of saw the writing on the wall for that. And then I had an opportunity to kind of get into designing and operating a data center co-location facility in Ottawa. And so that company kind of evolved into the next company. So I kind of had this eureka moment or understanding of, okay, the market's shifting from that one. So I better adapt or die. And so I adapted. And then again, at the second company, it was kind of that same thing. We were getting customers, but we kind of saw that the customers were getting bigger and bigger, or they were going to AWS. And we weren't really well positioned in Ottawa because of the high cost of power and the tiny market.
But you did own, like in the first company, it was more consulting. The second company, you actually, you owned and ran like a data center.
Yeah, that's exactly it. So I used the consulting engineering kind of skill set that I developed at the first company to build a low cost data center and operate it. So we were able to build a data center for less money, and that allowed us to launch the data center and be competitive in the market, get our kind of foot in the door. Yeah, and then we kind of we saw the market shift, and we saw more and more customers needing more space, and the smaller customers were all just going to AWS, and so that company wasn't really well positioned to handle those large customers. We were losing those deals to people in Toronto, people in Montreal. Ottawa is a secondary market. I kind of just saw that market not really being able to compete on an international scale with all the consolidation that was happening. So we were able to exit that to Rogers in 2014-ish. And I kind of said, okay, by that point, I had like this laser focused vision. And I was like, okay, if I'm going to do one more company, it's going to be XYZ, like these exact things that were going to happen. And I'm just going to strip out all of the waste that was kind of happening at the second company, and got really, really super focused in on this third company, which was Root Data Center in Montreal. I said, I'm only going to do it if I have 3 shareholders on my cap table. I don't want to deal with 50 shareholders.
How do you even think about a data center company, like let's say Root, specifically your company? Like, is it a tech company, or is it more like, I don't know, like a 3PL, like a warehouse almost? It's just, it's compute, not, physical goods sort of thing.
So that's a really good question. Depending on my audience, I have a different answer, but I like to call it tech-enabled real estate. So it's a very traditional space, data centers. It doesn't move fast in the way that software moves. There's a new coding language to learn every year, like it's first principles, fluid mechanics, and it's all those things. So that doesn't really shift too quickly. So that part is more like real estate, right? So you're building a building, you're using kind of this like established design principles.
And you were building these buildings from scratch?
Yeah. So I designed, my background was designing, engineering, project managing the buildings, the construction of these buildings. We would do brownfield retrofits. Some people would build like the shell. We would generally go in and take over an industrial building and convert it into a data center space. And there's a variety of reasons that we did that.
What's the cost? Like especially when you started, like what would be more or less, like you probably don't remember, but like what would be more or less the cost of that first building?
Oh, I mean, I definitely remember
because it's so painful. It's one of those...
Yeah, so like one of my obsessions, and I think founders have all these like different founders have these different kind of weird quirks about them, and I would say one of the things that is kind of quirky about me or weird about me is like I have this obsession about efficiency, and when I see something that's not being done as like efficiently as it possibly could be, it really like bothers me. And so like with the data center business, I was like, this could be more efficient, this could be more efficient, this could be more efficient, and so like with the brownfield retrofit, I was just like, okay, I could build a new building, but that would take me like 18 months. Or I could go and like, take over an industrial building and convert it. It's basically going to be the same thing, but I can do it in 6 months, and I can do it for, X% less. And so our cost to build was $3.5 million per megawatt. And in Canada at the time, we were seeing our competitors build it like $10 million per megawatt. In Canada. In the US, they were more competitive. They're more like, 5-6.
For simplicity, like when you measure per megawatt, you're measuring like is that like per compute, per energy, per compute, like per what?
Yeah. So there's 2 kind of core metrics that our customers would buy. They would buy square footage space, which is your cabinet space, and then they would buy megawatt, which is the amount of compute they could basically put in there. So like AI is using a lot of power compared to what like kind of old compute or not old, but the traditional servers would use. So we use and the cost, the power was the more expensive component. So like cost of space was 10%, and the cost of the power on the capital side was like 90%. the power and the cooling and all the stuff that went to support that. So yeah, so that's why that dollar per megawatt number is really important in the industries, because that's where most of the capital expenditure goes into. And so everyone gets very excited about where's their dollar per megawatt cost of construction.
And then for clarity, like that first building, how many megawatts would it be? Like how much money did you actually need to just get off the ground?
For Rue, we went out and raised $3.5 million. That came from 3 investors, one of them being myself. So we all kind of threw in equal amounts.
That was from like money you would have gone from the past exit?
Exactly. From the prior exit, I rolled that over, and I put in some sweat equity, so just like converted my annual salary into my contribution, basically. So that's how we kind of.
I'm curious, by the way, and I don't go on tangent, but how all in did you go? Like, did you take like half or more of your money and run into stick for business?
Yeah,
or did you like?
I mean, like all of it. I'm almost always like 99%.
Nice.
my business it's super stressful, but like when I'm on the toilet. And it's the only way I know to do it. And maybe other people know how to do it in a better way. But like how I did it was like, I'm on the toilet, I'm thinking about my business, which, is not necessarily great for relationships, but it worked out well for
That's right.
for my companies.
So you went all in. You basically, whatever winnings you had, you put it back to work.
Yeah. Looking back, it was kind of insanity as someone that's like gone through it now. It's like, man, I can't even think about doing that. But like when you're young and I was 28, 29 when I was doing the third one. So I was just like, all in, right? If I miss, then I'll just go work for somebody else and go down a normal path.
It's not as silly as it might seem. I think given like who you are, I know who you are, I know how all in you're going to be, the business super well, you've de-risked it, and frankly, worst case scenario, you can start again. You know what I mean? Like it's not as crazy as it might seem.
Yeah, that's it. So we're kind of all in, and so we raised $3 million, 3 shareholders, equal ownership, and that was kind of like I wanted everyone to have an equal say. Not to have shareholder infighting. Like shareholder infighting can destroy companies. And, we had some of that at our second company. So I really just wanted equality across the cap table, one class of share. And then we went out and raised, we started growing really fast, signed some big deals. And we went out and raised $20 million from a private equity.
This is before, or do you sign deals and then raise and then build, or do you sign, build? Like
yeah, so that was fun. That was kind of like it was a chicken and egg thing, right? And so we had to figure out how to do both at the same time. So we kind of raised money in parallel with signing a large customer contract, and that basically the equity went to finance that. But anyway, it was like both of them had to believe it was going to happen. And then you manage that, and then it does happen, and then everyone's happy. So we raised $20 million from a private equity group in the US called Abri. They I think have $6 billion under asset management. They were kind of like the leader in the data center space and financing at that stage. So we
And is it pure equity or is there a debt piece?
Yeah, so it's a debt mezzanine. So they gave us it was 20, I think, and then and they got a certain percentage of the company, and then we had to repay that. It was a great deal for them. Like you got the debt component and they got equity in the company. And it was great for us because we had to give up less of the company than we otherwise would have. Like we put in 30 and then we 3 and then we raised 20.
Well, this is a part that's not like tech, right? In the sense that these are a bit more predictable. Right. You build it out, you've got the customers for it. So you can lend against it versus just take like an all equity risk.
That's it. They look at it and they're like, okay, there's an asset that's backstopping this. There were some intricacies in our customer contract that, it was a large contract, and if we screwed up, then there may not be an asset for it to lean back. So it was a little bit more complicated than a traditional real estate deal, but there was like parallels in terms of how to finance it. And then we were growing really, really fast. So then we were growing 400% year over year. Our customer just grew too quickly. Blew out the top of our projections. It was like so much demand. So this is from a
single customer early on?
Mostly driven from a single customer. We had other customers that were kind of coming up behind it, but we were just blew out all of our kind of top model forecast projections. And so, just managing kind of this 400% year over year growth for about 3 consecutive years. And then we had to go and raise more money. So we went and raised $100 million. That was a more traditional debt deal. Like they gave us, we could do full debt or we could do a little bit of a warrant kicker and reduce our interest rate and, de-risk it. And so being, great conservative Canadians that we are, we're like, we'll take the lower risk deal and give it a little bit of, equity on that.
And that was was that to add more customers at that point, or was it just to fulfill that one customer's demand?
Yeah, that was to add more customers. We at that point, so with that second deal, we expanded one of our sites. We built another site. So by that time we had 3 sites that were kind of being simultaneously constructed in Montreal. And there was like milestones in there. So like the 100 million didn't come out all in one shot. It was kind of like X revenue, we released the next tranche, X revenue will release the next tranche, which was great for us because if we weren't generating that revenue, we didn't need more money anyway. So so that was kind of just tied to those milestones, two milestones.
And what, like, you're talking about, like, you get over 100 million in revenue. Like, what kind of revenue numbers, high level, did you get to?
We never really publicly disclosed that, but I would, we would have got, when we sold, we would have got like a tech revenue multiple kind of comparable to someone like NVIDIA.
Round numbers are talking like tens of millions in revenue and hundreds of millions in terms of like exit value sort of thing.
Exactly.
And then going back to, because the original question, so that's the real estate kind of component. What's the tech component of it?
Yeah, so the tech component was, okay, there's different ways, different technologies that you can use to service kind of this customer power requirements, and then assembling those different components in a way that allows you to build your infrastructure really quickly. And allows you to build it for less money. Why that mattered in our space, like imagine you're building a house, right? And you can build a house, your neighbor's building his house for $500,000, but you can build your house, exact same house, like 3-bedroom, same finishes, but it costs you $250,000. And they're right beside each other. You can go sell that house for $550,000 and make $300,000 in profit, and the neighbor can go sell his house for $550,000 and make $50,000 in profit, right? So because we're able to build for less and basically sell our product for the same, or actually we found out we could even at some times sell it for more because we could deliver our product to market faster, and some people would pay
premium, right, just to get that. Yeah, it's the same now. It's happening, but in the AI side, right? There's a premium to just getting access to chips. Yeah,
exactly. It's the exact same thing as going to video. People pay more money to get the chips today versus in 6 months from now. There's an opportunity cost for customers in that space, and there was one for customers in our space as well.
I'll pick up on something else you said earlier, because now I've seen this multiple times. We just had founder of Bridge. I don't know if you saw, they got acquired for like $1 billion by Stripe recently. And when they launched, this is like totally different industry. It was stable coins, right? When they launched, like almost all of their growth was just this one customer. And so you mentioned that, and I thought of that. And there's other examples that come to mind. There's some in our own portfolio, especially the ones that are kind of like transaction volume driven, right? It's not like classic B2B SaaS. And it's just kind of crazy, like, again, like shifting maybe to the investor side, like how much more common that is, because the normal adage is like, you don't want to depend on a single customer, which I guess like all else equal, you don't, except sometimes you do, and it's freaking great, and the customer explodes, and that's the reason you win so big. I don't know if you've seen that as you now, like you've invested now in 20 companies. I'm sure you've looked at hundreds, like if you've seen that as well, or is that just more like just happened to you, but it's rare?
Yeah, I mean, it happens, and I see it. You can get customer concentration risk, and you can get supplier risk. Like if you have a marketplace and all of your revenue comes from 2 people that you're referring deals into, and one of those guys disappears, that's also challenging, right? So yeah, definitely. I mean, customer diversification is nice in an ideal world. But as an early stage founder, you take what you can get, and you worry about that. You become aware that problem exists, and then you just figure out, how do we mitigate risk against it? I think we bought contingency insurance, or operate, we would buy certain types of insurance policies to protect us against specific things, related to customers, stuff like that. So you kind of look at that risk, but ultimately, if someone's gonna, give you a deal, you generally say yes to it. I mean, there's times like crypto was blowing up in 2021, and we said no to a lot of that business because we didn't want to be concentrated in that industry, and it ended up being the right thing for us at the time because some of our other competitors said yes to it and got themselves into trouble. But yeah, you just kind of generally want to manage risk as best you can.
And I think the other thing is, at least it speaks to me, is like at the end of the day, like, you're looking for product market fit. And yeah, like in an ideal world, there's 100 different things you worry about. And like, hopefully it looks like this, but like, as long as you get real product market fit, like that's the most important thing, however you get it.
Yeah, that's it for sure. And there's advantages to, customer concentration as well. Like you can create synergies. Sometimes an acquirer will pay a premium to have revenue from one specific customer because they want that individual as a customer, and it blends well into their portfolio. Maybe they have the other 4 customers in the market and they are missing that one customer. And so they want to kind of merge them together, and then an acquirer can take that risk off the table. And so they actually will pay a premium for that. So yeah, it's all about it. So how you fit into the market and how to maximize value for your shareholders.
So let's talk now about the investing side of things. You were telling me that you kind of have over time developed, let's say, like a framework for how you think about evaluating angel stage investment. So I'm thinking like, let's go through that. And I think like most people that listen to the show, like they're not investors, they're early stage founders, but I think most of them want to raise money or have raised money. And so it's more about the perspective of like them thinking about how an angel investor might think about them, right? So anyways, that's just a frame of mind that we're going through this. But yeah, maybe we can just kind of go through them one by one and just riff on each one.
Yeah, absolutely. So I would say one thing I'll kind of preface is, I mean, we're a family office. And so family offices can take risk in ways that VC can take risk because it's generally like a single individual, or if it's a third or second generation family office, maybe there's a couple of people making a decision instead of an investment committee. So we can make decisions quickly. We can take on risk like VCs can take on risk, but we don't have to allocate capital into early stage companies as an obligation. We can, if we think valuations are great in that space, we can buy into that space. If we think they're great in the treasury bill market, we'll just sit in, cash and buy US government debt.
Well, I think, even just as one of the things that to me, like, and again, like thinking about founders is like, there are hot times and there are cool times. And it's exacerbated by the fact that most VCs can just pull out of the market. Like the reality is if our firm, we deal in a relative world, like if our firm says prices are really high today, sure, we could sit and do a little bit less, but we can't just exit the market for 2 years until things come back to normal. It's just not our business model. And so that's power to the founder, which is like, if you find yourself in 2021, like, yeah, you definitely should go out and raise because it's an opportunity and people will still fund it. Even if they all agree prices are wild, it's still going to happen. And that's not the same as other markets.
Yeah, VCs can't say we're going to take a 2% management fee and draw and put your money in cash and earn 0%. And I feel you're going to lose 2% with us.
Tough model.
We can be a little bit pickier in terms of, velocity we need to move. When we see, like in 2021, we didn't do anything, or I think maybe we did one deal because it was just too hot. And it was just, I was like, VCs have fun. And I told my founding team, I was like, this is the best market. If I was you guys, I would go raise, because like, even if your company is stronger in a year, you may not get the same valuation as you can get today. There's just so many people. This is a seller's market today. It's not a buyer's market. And yeah, just go raise capital. So we stepped back during that period, but 2019, 2020, we're more balanced. Today, I would say is like balanced. I mean, today is probably even a little bit more difficult than 2019 and 2020, maybe more comparable to like 2010, 2011, which is, creates a healthy ecosystem, but it's hard for companies as a founder when you're going through it, for sure.
So yeah, so what are some of the things that you've learned over your time as an investor you're applying today?
So we kind of have like 5 things. I mean, there's standard stuff that kind of everyone looks at, like competitive landscape. Do they like the founding team as individuals? Kind of the basic stuff that everyone will look at. Through the 20 deals that we've done over 5 years, we've had time to kind of look back and seeing what works and what doesn't.
Normally your check size is what?
Yeah, we were doing like 100K.
100K at like pre-seed seed.
Yeah, pre-seed seed, and then we save space for follow-on. We know that we're likely going to double up or triple up as the company evolves if we're happy with the progress. So, that our target allocation is probably 300K to a company that we like by the end of the process. What we do is kind of look like these pass-fail criteria in addition to the standard stuff people look at. And so one thing I really didn't appreciate as a founder, but I came to really appreciate as an investor, is the why now slide. And Sequoia was like, I think it was Sequoia. I was like, this is magic. They came with the why now slide. The industry was like, wow, oh my God, it's amazing. And as a founder, I was like, I don't understand why that slide is so important. It's what I tell founders. I mean, the slide allows investors to be mentally lazy, right? Because, investors look at a lot of deals. Your company is very special to you, but to an investor, you're one of 100 deals they've looked at that week. So investors are just seeing a lot of volume and they need ways to be mentally lazy and look at things quickly and be interested or not interested. So, so the why now slide for us became very important because it allowed us to be kind of mentally lazy, and it allowed us to say, okay, we assume that every idea that we're going to see has been thought of by someone else before. Your idea is not unique and special. As a founder, I thought my idea was unique and special, but I'm sure 10 other people have the exact same idea is me. Yeah, so we look at this why now slide, and it basically enables us to kind of think of the idea that we're being presented as like, okay, there's a true like genesis, there's a true reason why this idea came to exist very recently as a result of something shifting in the world. And so that says, okay, 5 years ago, no one would have come up with this idea because, the Apple iPhone didn't exist, right? Like, or crypto didn't exist, right? So before crypto, this idea wouldn't have worked, or before the iPhone, this idea wouldn't have worked. So that's why we want through the why now. Because it says, okay, this idea is relatively fresh because something has changed in the world around us that has this idea make sense today.
Do you depend on the founder to identify this for you, or do you just try and, because sometimes as a founder, like you stumble upon something, you start building, you get traction, like things are moving, you haven't necessarily taken the time, especially at pre-seed or seed, to like reflect like, hey, why is this happening now? And so is that to you like job of a founder or job of you, the VC or investor at that point?
If we get pitched and we like kind of the other parts of the business and they don't have a why now slide, I'll talk with the founder and be like, hey, like tell me why today. So I'm not gonna be like, hey, you didn't do a why now slide, like, but they maybe even think of it as like, why is this so important? And I may see the why now, but I want them to tell me the why now. So I'll generally try to work with them to kind of come up with that slide or polish that slide.
But I think, the key point here, I think, is timing is obviously critical. Like, I think for the way we look at it is like team for us is number one for the simple reason that you can actually like identify if it's a great team or not. More than timing is, I find, a little bit harder. But at the end of the day, if you look back, at least retrospectively, like timing is the big driver of, why things work or didn't. Like, take Uber, take whatever you want to take.
Absolutely. The why now slide very much plays into that timing element and helps kind of like make that a little more tangible for us, at least anyway. The second component we kind of look at is the TAM, which I also didn't really pay too much attention to as a founder. And in Canada, we kind of have this like issue, I find, where kind of a big TAM, or at least when I was starting companies, big TAM was kind of a bad thing, right? You go pitch to Canadian VCs and you want $10 million and they're like, why not $2 million? And it's like, well, my idea is this big. I was never encouraged to really go after big TAM, and I didn't pitch in the US too much early on. But for us, big TAM is important. That's kind of common in DC space. A lot of people, but we also want to see as part of a big TAM, it's less common, is a path to kind of hover near break even or even generate free cash flow in the early stages too. So I'm not expecting if we're a pre-seed seed year one that you're going to execute on that as a strategy, but like there's a way, you're going after big TAM and there's a branch that you can kind of move off of year 2 or 3. If you're not hitting that right away, that you can kind of hover around break even. And all this stuff on paper, we know changes over time and things evolve, but it's just like seeing the framework, seeing how the founder thinks about that, that there's alignment for us with them on kind of those two things.
Why is that so important? Like, why is the free cash flow versus like the blitzscale model?
Yeah, so free cash flow, if you can be near break even, you can kind of control the dilution, right? And so people will give you better terms. One, when you're just like growing off the charts and things are amazing, then everyone's going to be clamoring all over you to give you money. But that doesn't happen for a lot of companies. And so, the other lever you can pull is kind of hovering near free cash flow, make a little money, and then you just can wait for the right time to go out and raise, and you can get good terms that way. So the best time to raise money is when you don't need money, or when you're just, I guess growing like crazy and people just are throwing it at you. So it helps manage that risk. And then the big TAM is really, it speaks to the right tail for us, is kind of like IRR and returns for a portfolio in the space are very, very sensitive to the right tail. So if you have one company in your portfolio that does 100x, you're instantly a top decile VC, right? So you want to leave space for that kind of right tail. 10x is great, 100x is 10 times better. So we like to see the big TAMs like, okay, this is how big it could get, and then probably it's going to be somewhere between the TAM and the TAM.
We have tens of thousands of people who have followed the show. Are you one of those people? You want to be a part of the group. You want to be a part of those tens of thousands of followers. So hit the follow button. How sophisticated do you get on like TAM, SAM, whatever analysis? Like I honestly, I find early on, like I think for me at least, the way, and I'm curious how you do it, like for me, it's like, it's almost like a check the box sort of thing. Like I want to do back of the envelope math and kind of say like, okay, yeah, could this do 100 million in revenue? Yeah, I can. Okay, cool, I'm good. You know what I mean? Something like that.
Yeah, absolutely. It's an art. more than it is a science. And it's kind of like, is there a realm where this kind of makes sense? You can do a top down, bottom up, and there's different ways to look at it.
Because like some people get over like, oh my God, this could be 10 billion a year versus this could only be $1 billion. I'm like, man, it's nothing right now. You know what I mean? Like, let's get somewhere. Let's get somewhere first. You don't want to be selling like, trombone oil or whatever that expression is, where it's like, the market is $1 million a year max if you hit everybody. But beyond that, like once you can get to over 100 million, you're going to have to stack different products. You're going to have to expand to different verticals and all these other different things to expand your time if you actually get there in the first place.
And I would say almost prefer more like less math on it, more like less conditional positive outcomes. So, one if-then statement versus many layered if-then statements. So I want one good thing to happen for the TAM to play out versus 5 good things to have to happen for the TAM to
I hate those
out.
ones where it's like, look, sure, our business model is this, but like if we get that, then we enable this business model. If we do that, then we can do this, and then it's a big thing. It's like, that's a lot of ifs. That's tough.
Yeah, and I've certainly been guilty of myself of too many if-then statements.
And the free cash flow, by the way, like I'll just double down now because I actually think like founders have gotten. I think like the Blitzscale thing was super hyped up. And the reality is it can work. Like in some cases you have to do it. You're an Uber, like you're maybe an Airbnb, not really, but certainly like a PayPal, like you got to do those blitzscaling motions. It almost got conflated where it was like, if you want to be in unicorn, you got to blitzscale. And maybe in some environment, because there was so much money, you kind of had to, but I don't know. And I think in any case, as a founder, being able, like minding that bottom line, minding your burn and therefore getting close to break even or, whatever they call default alive, whatever you want to call it, like, is so important. It just gives you so many more choices. If you're like, whether it's power on fundraising, whether it's waiting for that right inflection moment, or whether it's like, hey, this business is never going to be nearly as big as I thought it was, but I'm still going to make a few million off of it instead of just like burn it.
Yeah, absolutely. Yeah. And I think a lot of people forgot the lesson. I mean, Blitzscaling is a great book. And my biggest takeaway from that book is you want to spend as little time as possible blitzscaling. And I think a lot of people have gone away from that kind of core fundamental point of that book. There are times we need to blitzscale, winner takes all. But like people were applying that 90% of cases when really it should be applied in like 2 or 3%
That's right.
of cases.
Okay. Point three,
hungry founders. So I would say we have not had great success in investing in founders with large successful exits, and reinvesting in myself would be, case in point in company number 4. But I have buddies that I've invested in that did super well, and and I was like, anything they touch is going to be fantastic. And I would say, with all of them consistent, myself included, is kind of a lack of hunger. There's too many distractions. I couldn't, think about my business as like the only thing when I'm on the toilet. And so, that was a challenge that we've kind of seen in the 20 companies that we put money into. All of those companies kind of really struggled. So we actually, contrary to a lot of people, would prefer that they not have had a large successful exit. Like enough money to, buy a house is okay. Like your house is not a distraction. Your house is like financial stability. So someone that's had a moderate level successful exit, that's a good thing. But like a huge, they put $100 million in their pocket and want to go start another $2 million company, raise $2 million, then like that we struggle with. And we generally prefer founders under the age of 30 to 35. I'm not sure if I get in trouble for
I don't know who can put you in trouble, man. You got like, you're doing your own thing, so it doesn't really matter.
But there's a reason for that. I mean, is that as we get older, we tend to make decisions more on an experiential basis. Like I think of how my brain works today versus when I was younger, and everything was possible. When I was younger, I had no experience to tell me it wasn't possible. But today I'm like, oh, this could be cool. But then I was like, well, I did this, and this thing before, and experience tells me this is not possible. And, some of that jading that we have as we get older, I think can dampen our creative abilities. And so like it works great. Like, I mean, if I'm looking at the founding team or Series B team, I want an experienced CFO. Like I don't want financial innovation in like, a SaaS company. So that's all I'm looking for. So CFO, that role is great to have that experience. But like the tech guys, the disruptors, like I would love for them to be young and hungry because, they want to break things. You look at all the big companies, the FANGs that exist today, those are all started by young, hungry guys or girls. And
I mean, that's interesting. So there's this book that's really changed my perspective a lot on like venture investing. It's called Super Founders, because they did the analysis in a way that I thought was pretty compelling. They looked at, I don't know if you've seen it before, but they looked at 20,000 seed stage companies and then just looked at the top 1% that actually became unicorns, so 200 unicorns. And they just did like basically so many different factors, like, what do they study, what school they go to, how many years they work, experience, whatever. whether technical versus business founders, and just looked at control versus success. And two things. One is I don't remember exactly. They drew the line for a super founder. You have to sell your company for 10 million or more, or grow a company to 10 million in revenue or more, which wouldn't put them in your 100, like, you sell a company for 20 million, you're a super founder. You might have made, let's say, $2 or $3 million. So you're still hungry. So I don't know beyond that, but like what you say makes sense to me. But the second one was interesting because I had that same mindset that you just said about kind of younger founders, and I'm biased too because I'm younger, so I think there's a natural affinity there. Plus, you have if you look at the big ones, like the top 5, like the FANGs you talked about, they were mainly younger founders. But the data actually showed that like 50-year-olds, like 60-year-olds, they start way fewer companies, but actually the odds of success are no different than 30-year-olds. So I wonder if it depends on the industry. I mean, if you want to start the next like agentic AI company in some new vertical, you probably want to be younger because there's not much experience there. Certainly in Web3, like you probably want to be younger. Social, like anything like the next TikTok or whatever is not going to be from. But if you want to just like, you're in like, I don't know, so like health, let's say, and you see an opportunity, you could probably create a multi-billion-dollar company by, but their experience might actually be helpful. I mean, I don't know if you agree with that, but that's what the data like seem to suggest. At least that was my interpretation of it.
I 100% agree. Like if I'm going to invest in an HVAC company, that my expectation is they generate me 10 to 20% free cash flow yield and they grow 10% year over year to infinity. A 40, 45-year-old, 50-year-old is great. Like that's a great industry
but beyond that, like even within tech and even potential for unicorns, just less like existing market versus new market, I guess is my thinking.
Definitely. I mean, when new innovation is required, I kind of lean on this kind of under 30, 35 more. And it tends to be, and we're talking about VC today, so it tends to be that a lot of those 10 to 100x ideas are in industries where there's new. It's not always. It skews that way, I guess. But I don't know if I've read the Super Founder book, so I'm gonna have to check that out. I'd love to see some data on it.
Yeah, check it out because even on that, the existing and new market was like almost 50-50. Like it's weird. There's a lot of stuff but the data is imperfect, so like I don't think it's the end all be all. I would consider it like probably the best study I've seen, but like at the end of the day, it is one study. But there was a lot of things like that I found counterintuitive, like counter to what my gut would have said. But anyways, there's a million ways to play this game. Okay, cool. So what's point 4?
So the fourth one I like is long-term corporate sustainability. So there's some businesses that are built where there's like a really small window of like success to exit. So you've got like, if you don't exit in 3 years to one of like the top 20 companies in the space, like you're building this company to be acquired. So I struggle with those because if you miss that window, it's like it's going to be a very fast zero, most likely.
Was that not the case with Root? Would you say Root fell into that or no?
I would say part of the reason I wanted to sell Root was because I was becoming very concerned about that item.
Right.
and the way that the industry was starting to operate itself. So yeah, that's kind of why I pushed to kind of move forward with the process. But
at the outset, you're trying to de-risk for that, if you can see it like at the time of investment.
Yeah, exactly. So just kind of de-risk, and there's lots of companies that can be financially viable long term, and it ties into like kind of that near break-even FCF backup plan.
Well, there's a lot, like we saw like the most recent example of that for me was like prompt engineering companies, right? It's like, oh, prompt engineering, like you're gonna need to do that, and I'm like, well, like the whole point of all these LLMs is to understand natural language. So like you better believe that they're all trying to make prompt engineering effectively useless because they're just going to understand what you want when you say it. So like there's a time and window, like right now it's really needed. You go solve it, you become the leader, and like your market is just going to shrink over time until it's no longer a problem. Like, and there's always those, same around like bandwidth or like different things around compute that kind of like exist now as a problem and are for sure not going to exist, 5 years from now. And yeah, it's kind of adding a new element of risk because not only you got to get it right, you got to get it right. Like you got to hit at that point or it's over.
Exactly. So yeah, so that's kind of what the fourth one. And then the fifth one, we categorize kind of two companies. Well, we like two categories of company. I want a marketing type company or I want a tech company. And so marketing type company, I would say is like, a coffee company or like a whiskey company. Something that exists today where really, and there's lots of varieties, and I'm just using those two as an example. And so something exists today and it's really a marketing problem is how do we acquire customers for less money than our competitors to grow faster, to basically reinvest the free cash flow to grow faster. So how do we solve that? And for those companies, I want to see a marketing founder lead the company, because that is the most critical problem for that company to solve. And then there's tech companies, which like there's a lot of technology risk, but if you can build this thing, it's basically going to sell itself. So like a chimp can sell your product. Like customers, if it works, customers will be calling you nonstop. You don't need a good sales and marketing team. It's just like it will sell itself. So I kind of want to see companies in those two. And for that company, I want a tech founder running that company. Like I don't want a marketing CEO slowing down tech decision making. The tech guy needs to be, or girl needs to be the leader. So we want to see kind of those two categories of companies. And we generally like to see 2 or 3 founders in place. Just generally, single founders can work, but it's just very rare that a single founder that's strong technically is also strong on the marketing side. It's just the way that our brains kind of work. Like I can struggle through marketing, I can struggle through sales. I'm okay with it. I've done it, but it's not my superpower. I'll be a 6 on 10, like 7 if I really, really try, where like someone else, just naturally does it. Where engineering can go on all day with that type of thing, right? So we generally like to see a team of 2 or 3, and then I prefer 2. 3 is okay. More than that, it just becomes like this consensus decision making that tends to slow down the business, and people are just there's just wasted space on the cap table. Generally, like the problem is if there's 4 people needing to solve the problem is generally probably too complicated.
And I think, for the solo founder piece, like I think to make it work, because it can't work, but you do need to have almost founder types. Like really early on, I would say, whatever your weakness areas are, you want to get some generalists that can run around in those circles, because it's really hard to find, like, in this 0 to 1 stage, I find you're like not really ready yet for many heads of, because those departments are almost too small. But you do need somebody to run them. So you kind of need somebody who's a generalist, come in, let's say you're technical, do sales, like get it kind of going, then do marketing, get it kind of going, do support, get it kind of going. And then, and then maybe once you get to like $1 million or $2 million in revenue, then you start, filling in heads of. But finding somebody like that who can complement you, maybe they came later, so they don't get, half the company or 20%, they get 5% or 7%. They're not technically a co-founder, but like are actually incentivized and are thinking like you as an owner. But yeah, I think you need something like that, unless you're very experienced, and then maybe it's a little bit easier. You start with more money or something like that. But otherwise, there's always gaps you need to fill.
Yeah, there's always gaps that are going to need to be filled, and you just have to wait till the right time to fill those gaps, and you got to fill them in as best you can while you're waiting to do that. And I guess I find like a technical founder is generally good with numbers, so they can generally fill in the finance gap early on. Like building a spreadsheet is generally less difficult than programming in AI. Like programming in Python is generally, you can write a Python code to automate generation of financials if you wanted to, right? So unlike someone that's good at marketing, they can generally do sales pretty well because they're generally an extroverted person. They can generally manage HR because they're generally good with people. I find like those 2 types of brain, those categories tend to work well together.
Listen, let's stop it there, and I'll ask the 2 questions we kind of always end on. The first one is, and I'll ask it a bit of a different way, like, but because of your experience with Root and now investing in 20 companies, like, what is your latest kind of definition of product market fit? Like, what is product market fit to you?
Yeah, that's a great question. So for me, so I was researching this the other day with one of my companies, because my definition was different than theirs. And I thought theirs was okay too, but for me, it's like backbreaking customer demand. Like you have so much demand. The problem for the company is not customers. It's like trying to operate the company so that it doesn't fall apart because there's so much demand for your product. So that's like, if you look at like how like Facebook grew, or like, some of those companies, like that was their issue once the engine started going. And that's what I felt we experienced at Root. And it's hard. I mean, you can be successful as a company without hitting that. So like, don't get me wrong, like you can make it Series E, Series B, Series C, and eventually get to that point. But for us, that's kind of, and there's like leading indicators on that we like to see and look at.
What are some of those?
I mean, there's 6 standard ones like for that you can measure. One I would say that is interesting is we look at like at a very early leading indicator is conversation to conversion ratio. So like that's something that generally is not typically measured. But it's especially useful in like a B2B business where there's a sales process, like an actual personal sales process. And you have 5 conversations and 4 of them become customers, and you've only had 10 conversations and you have 8 customers. I'm very excited.
Lately, it's great you say that. Like lately, in the really early stages, that's the number one PMF early indicator for me is like demo to close, whatever you want to call it, closing, because of exactly that. Like that's the, like, you just think fundamentally, like, do people really want your shit? Like just saying something to them and they're buying the thing at more than 50%, I would say that's a pretty strong indicator that you're selling something people want. Can you deliver on it? Like, can you get a lot of customers into your funnel? Like all these other things need to, ultimately be true. NPS, whatever. Then you have like later on the Sean Ellis test, like retention. You got all these things, but you kind of need customers and data to get that. Whereas like sales to demo to close, you can get like, month one, you can start to understand what that looks like.
Yeah, exactly. Absolutely.
And then the last question is, what's one of the top pieces of advice that you would give early stage founders, just given everything you've seen and everything you've learned?
There, especially for founders looking to go down the VC track, I think there is this general desire, and I was part of this, to kind of go out and raise money as soon as you feel you possibly can. A lot of the time will result in is a lot of extra cycles being spent and months of raising and actually turning some investors off that would otherwise be interested when you're actually ready to raise money. So there's this kind of like, sometimes you have to go slow, go fast. And so it's like, you have 6 months of runway left and you want to start raising today. And that's what I would have done like in the past. It's like, I got 6 months, I better start today. I think now Jason would kind of say is like, okay, you got 6 months left. What can you get done in the next 4 months that makes your company stronger, that gives you highest probability of success to close in 6 months? And focus 150% of your energy on getting those, 5 things done so that your metrics look better. So whatever it is, they look better. And then you start raising 2 months before you run out of money. And I think it just gives you a better chance of success. Like you can build your list while that's happening, but you don't talk to anybody, or maybe you do some like really ugly pitches early on to people that are like on your C list that you don't actually want to take money from, but you want to start practicing with. Yeah. So that's probably, I think, one of the biggest lessons I've kind of learned over the years.
I love that. I think it's super counterintuitive and much more likely to be correct, because the reality is all you're doing is, if you don't have the story, you're probably just burning conversations. You're burning doors that aren't going to give you second or third chances and not spending as much time on changing the story, right? When you spend those 4 months building the business, changing the story, putting up numbers, it just makes everything so much easier when you go out to fundraise.
If you have a bad first date, think about how many times you get to have a second date. And it's a lot of work to get that second date. You might as well just have a good first date.
Well, and especially look with investors, like I'll say this. I mean, if somebody pings me with a founder I haven't met, usually, like, especially if it comes from a good referral, like I'll take a look. But once I've taken a look, then I don't necessarily need to follow up on it. Like, okay, it's done. I've already passed. I've already made a decision. And I think it goes most people. So like, it's usually way easier to get the first meeting than any subsequent meeting after that. Cool. Well, Jason, it's been great having you on the show, man.
Thank you so much for having me. Keep doing the great work and sharing wisdom with the community.
Thank you.
Awesome. Thanks, Pablo. Have a good one.
Listen, when you go to like a restaurant, you eat a nice, meal, maybe a fancy one, maybe not. Do you leave a tip? I assume you probably leave a tip. You probably leave a tip 100% of the time. Well, guess what? A review is just like a tip. And I know you haven't been leaving one. So just like the waiter that doesn't get a tip after hours of great service, I'm getting a little frustrated. So take your phone out and leave a review. It helps the show move up rankings. It helps us get better guests. It doesn't just help me. It helps way more founders. Thank you.